Did you know you can borrow against your life insurance policy to pay off debt, invest in real estate, or even fund personal expenses like vacations? Today, I'm going to show you how you can do it. This strategy isn't about accessing money, it's about creating financial freedom and controlling your cash flow. So stick around and I'll break down the steps to borrow against your life insurance policy, how to do it responsibly, and how it can transform your financial future. Now, before we dive into borrowing, let's clarify what cash value life insurance is. When you pay premiums on a whole life insurance policy, part of that premium it goes to the death benefit and then part of it goes to a savings account side of the policy. This savings account is called the cash value. Think of it as a high interest savings account that grows tax free. Unlike your regular bank account, your cash value isn't subject to market fluctuations, so it's a safe, predictable place to grow your money. What's great about this is that you don't have to wait until you pass away for your loved ones to benefit. You can access your cash value while you're still alive. It's like having a financial safety net that doubles as a wealth building tool. So there are two main ways you can access your cash value, through a withdrawal or a loan. Let's break these down. A withdrawal is exactly what it sounds like. You take money out of your policy. While it's simple, withdrawals reduce the overall value of your policy, and it may trigger taxes if the amount exceeds what you've paid in premiums. Now, borrowing is a much better option for most people. When you take out a loan against your cash value, you're essentially borrowing from the insurance company. You're using the cash value as collateral. The best part, your cash value stays intact and continues to grow at a compounded tax-free rate. This means your money works for you even while you're using it. That's the beauty of this strategy. It allows you to leverage your policy without interrupting its growth. How much you borrow depends on how your policy is designed. For example, some policies are structured to maximize cash value in a longer-term basis. In these cases, a larger portion of your premium goes to cash value instead of death benefit. Let's say you have a policy with a 60-40 split. 60% of your premium goes to cash value and 40% goes to the death benefit. If your annual premium is $10,000, $6,000 would go to the cash value. That's the amount that you could borrow against, usually within the first year. Policies that aren't designed for high cash value growth may take several years to build up enough to borrow from. That's why structuring your policy correctly from the get-go is the most important thing, especially if you do want to use these policies to borrow from. So when can you borrow? If your policy is designed properly, you can often borrow within the first year, sometimes as soon as 30 days after paying your premium. Now, if you already have a policy, you can just request an in-force illustration from your insurance company. This document shows your current cash value and how it's projected to grow and the maximum amount you can borrow. It's important to note that every policy is different. If your policy doesn't currently have cash value or you're unsure how it works, just contact your insurance company to find out what your policy is doing. Next, we're going to borrow from our policy. Borrowing from your policy is a simple process. Here's how it works. First, call your insurance company and request a loan. They'll verify your cash value and ask for your banking details. Typically, the money is sent to your account via direct deposit within a few days. The loan amount will depend on how much cash value you have. Remember, this is a loan, so the insurance company will charge you interest, usually around 4% simple interest annually. But since your cash value continues to grow, the net cost of borrowing is often much lower than a traditional bank loan. Now, paying back the loan is just as simple as borrowing. You can set up a payment plan or make one-time payments at your own pace. The insurance company won't chase you for payments, but staying organized is crucial. The longer your loan is outstanding, the more interest you'll pay. So it's smart to have a repayment plan in place before you borrow. For example, let's say you want to use the loan to pay off your credit cards. What you'll then do is set up a schedule to pay back the insurance company instead of the bank, which would save you thousands in interest payments as opposed to just paying the credit cards. Now, this strategy isn't just for emergencies, it's a powerful tool for investing. Let's say you need to use the policy loan to buy a real estate deal. You can borrow the money and then repay the loan after the deal is closed. Because the insurance company doesn't require a rigid payment schedule, you have flexibility to wait until the investment paid off before repaying the loan. Meanwhile, your cash value continues to grow, allowing you to earn interest even while the funds are being used. It's a win-win situation. Now, I want to emphasize this. Borrowing against your life insurance policy isn't a free ride. It requires discipline and responsibility. The insurance company won't send you reminders or demand payments because your death benefit, it serves as the collateral. But to truly maximize the benefits of this strategy, you need to have a clear plan of how you'll use the money and how you'll pay it back. If you're organized and disciplined, this can be a game changer for your finances. Remember, the key to borrowing against your life insurance policy is leveraging it responsibly to create financial freedom.